Hey everybody, thanks for being here. Let's start with Fed funds target rate. I love Tom McClellan has awesome data on this, and he's been harping on this for years, I mean decades, honestly, showing that how the 2-year note is really where the Fed should keep interest rates just automatically instead of doing their manual increases and decreases on their own. They would be better off not doing so. So he said Jerome Powell stated in his interview Tuesday that the Fed is not done hiking rates, but he says they should be, since they have already surpassed the 2-year T-note yield, and bad things tend to happen to the economy when the Fed does that. The internet bubble collapse, the 2008 global financial crisis, etc. Even the COVID crash was a little bit. But what happens is the Fed funds rate is the black line, the green line is the 2-year note yield. When they get ahead of that, or when it crosses below, that's usually where the problem happens. And we're doing that again right now. And there's a lot of talk from a lot of people about how the probability of global recession is very, very near and coming up, but the inverted yield curve, which we have again, which we had before the COVID crash, is sitting there too. So that usually projects a 12 to 18 month recession that far ahead of time. So I don't know, we could have a great 2023 and then have a terrible 2024, 2025. I'm not sure, but it's at the moment things seem okay, but there's a lot underneath the surface saying that this isn't going to stay good for too long. And there's also a long-term real estate cycle that historically would bottom somewhere around 2026, which would put that right on schedule in a lot of ways. All right, our long-term cycle, long-term trend is actually positive. It is stretched again like it was last month. It is coming down a little bit, but that's positive. You know, we're seeing a lot of money flow coming into the market, and that's why we're not really too stressed about much. When this goes below this line, which is just a 55-day moving average, then money is probably coming out more than it's going in. So the long-term big picture seems to be pretty good. The midterm cycle went negative yesterday. Even with the market going up, and the next slide I'll show you this, we had a great run from beginning of the year into about mid-January, and then money flow's just been kind of trailing off with the market going up. That's usually considered a negative divergence, and the divergence usually wins, right? The money flow is coming out, so eventually the market's going to follow that, but it may spend a little time saying, now we're going to do our own thing for a little while, but eventually it catches up, and it seems like that's where we've just hit. Even this morning, the market was up quite a bit, and now it's not so much. And here's where I was talking about. The first part of that, when money flow was great, was from about here to here, and then from here to here, this little part is where the money flow decreased. So now the expectation is that it comes back down to this red line, which we put on the chart months ago, when we thought, okay, this is probably going to come up here and bounce. This is the S&P for the past year, and then it pulled back, and then it broke through this line, which has really been interesting because it's been in resistance in March, in the summer, in I believe it was October, November, and then it broke through finally in January. Ideally, I'd love to see it come down to this line, and then we could have a really good run up from there. So that's where we get the momentum is still there. It hasn't broken yet. That's why I have these little blue dots at the bottom saying things seem to be okay for now. So it's mixed. Money is coming out, but there are positive hints in the near term that we can focus on. The positive and negative sectors is 7 to 4. Interestingly, last month on our webinar, we still had, I believe it was energy and healthcare were both negative then as well. And now we've added on consumer discretionary and utilities. That's not necessarily bad for the market either, because these are all defensive names. And when the defensive names aren't doing great, that means the growth names are doing well, which is tech. XLK is trending up. Communications, which is really the Facebooks and the Netflixes, and financials are doing all right. Real estate's been improving. It had a really ugly last year. And consumer discretionary, and that's mostly Tesla's driving that. Tesla's having a good run off of its terrible last year. But you know, we're seeing growth names push the market. So that's again a short-term positive. I'll take that and think that we're not in too bad a shape. On the rotation, this is a mess. Here's our 3 defensives that are they up, are they down, are they sideways? They can't tell where they want to be. I want to see them push into the green. You know, you want to see into that green because that's where everything is leading T-bills, right? The risk-free rate. So if all the sectors of the market, which is what all these represent, if they're pushing up to the right, that's pretty good. And we've got the growth names here, the XLK, the technology, the communications, and the consumer discretionary are all in the box. That's great. Real estate's up there. Industrials are there. Energy is way weakening and heading to the lagging box. And then here's those 3 again. And, you know, it's a mess. It's a mishmash. And usually they all move in a very pretty cycle together. It's like watching fish swim together or something. They kind of go around the lake and just all together. But now they're just doing this messy thing. So I'm not sure where they're going to go. Something that we've added recently is we For each model that we have, we look at a benchmark of it. And sometimes I've found when we reviewed, what we've done well and what we haven't done well, is to sometimes we'd get out of the market, we're like, things look a little iffy, but then you go to the benchmark and like, it was fine. There was really nothing to fight against, or, we should have just stuck with it. Or conversely, there are times where we're like, things look good, but, and I'm thinking around the Russia, Ukraine incident, data looked fine a lot of those days, but we would have crazy swings or something would happen overnight, or Russia would attack and make something weird happen. So that's a time where our data said things looked okay, but the benchmark said, no, you want to play it safe. So we're looking at benchmarks right now. The only one negative, which is, again, refers to the rotation, is bonds. The BND is also the aggregate bond index. So general bonds are just went negative yesterday, and they're looking a bit iffy. No directional momentum has changed yet, but the rest of the indexes are pretty good. Even though our money flow went negative yesterday and we did reduce risk on that, we're keeping a lot of other money invested because the rest of these indexes are saying okay, which is like the S&P, which is VOO on this one. VT is the global world stock index, as well as AOR, which is a balanced index. It looks like a 60-40 stock to bond ratio. That's kind of helping us stay in the market a little bit longer than we should, and possibly keeping us out when we don't need to be. So really happy to add that. We've been slowly introducing that to each model and seeing if that helps or doesn't. It seems like it helps more than it hurts. So I always like seeing something we can do to improve our process. And then finally, just want to show you the dot. There it is on the bond index. Back here, when it turns orange or red, what happens? Not great. Turns orange, it wasn't bad. We just turned orange. And even back here in June of last year, right before things get bad, you get these orange dots. So that's where we are in the bond market. The stock markets have not done that yet. If they do, then we'll probably get very defensive, or even maybe start hedging or doing market neutral like we did last year, which really helped out a lot. So that is all I've got for this week. It's great to see everybody, and see you next time.